For most of the past 2 years, the story was pretty simple. Rates went up, buyers pulled back, and owners who wanted to sell largely held on. And the bid-ask gap was too wide for most of the market. But during this time, retail performed really well. Vacancy was and still is at historic lows, and tenants kept paying rent. Necessity-based retail, the stuff that fills most strip centers, kept performing because people still need haircuts, they still need to eat, they still needed their nails done, their taxes filed, their kids in daycare. So now we come into 2026 in a decent position. The Fed had started cutting rates, buyer appetite was improving, the market was finally starting to recognize things turning around for investment opportunities. And then over the past couple weeks, things have landed all at the same time, and that's what we're going to be talking about today. So let's start with the consumer because everything in retail real estate flows from what's happening at the point of sale. On April 1st, the U.S. Census Bureau released its advanced retail sales estimate for February 2026. Total retail and food services sales came in at $738.4 billion, up 0.6% from January and 3.7% from a year ago. That's a healthy number, but here's what's beneath that headline. The Conference Board released consumer confidence data this week, and while the headline index ticked up slightly to 91.8, their expectations index, which measures how people feel about the next 6 months, fell to 70.9. Readings below 80 on that index have often preceded a slowdown. We're sitting at 70.9. More telling, the share of consumers expecting higher interest rates over the next year jumped to 34.9% to 42.4% in a single month. The Conference Board pointed directly to oil price pressures and the ongoing conflict in Iran as drivers. The USDA's economic research confirmed this week that food away from home prices, that's your QSR and fast casual tenants, rose 3.9% year over year through February. Groceries rose 2.4%. That gap matters. When eating out gets more expensive relative to cooking at home, the consumer makes a choice. The winners in that environment are value-oriented quick service, not sit-down casual dining. And if you have a Whataburger or a Raising Cane's, you're doing pretty good. If you have a concept that's priced in the middle and doesn't have a strong value story, watch your sales data. The service tenants, beauty, fitness, nail salons, tax prep, urgent care, pet services, continue to hold better than goods-based retail. The Conference Board data showed that even as overall service spending expectations fell in March, fitness and beauty held relatively better than travel and big-ticket entertainment. That's a meaningful signal for the kind of tenant mix that works in a well-run strip center today. Now, let's add the layer that arrived this week on top of all of that. The Yale Budget Lab released its updated analysis on April 2nd, a comprehensive look at where we stand with tariffs, and the numbers are pretty significant. When you combine the tariffs already in place with the new Section 122 tariffs that took effect in late February, the average effective tariff rate on U.S. imports has increased by nearly 20 percentage points. The estimated short-run consumer price impact, 2.3%. That translates to an average purchasing power loss of roughly $3,800 per household. Now, a quick note on the legal mechanics here, because most people haven't heard of either of these laws, and it helps to understand why this situation is still unsettled. The administration originally used a law called IEEPA, the International Emergency Economics Powers Act, as its legal authority to impose sweeping tariffs on nearly every U.S. trading partner. IEEPA is a law passed in 1977 that gives the president broad powers to regulate international commerce during a declared national emergency. The administration argued that trade deficits constituted that emergency. And in February 2026, the Supreme Court ruled 6-3 that IEEPA does not, in fact, authorize tariffs. those tariffs were struck down. Now, in response, the administration pivoted to a different law, Section 122 of the Trade Act of 1974. This one does specifically authorize the president to impose emergency tariffs, but it comes with limits built in. The tariff rate can't exceed 15%, and the authority only lasts 150 days. Those Section 122 tariffs took effect February 24th and are what's primarily in place today. The clock on their expiration is running. Now, what this means practically, if the administration wants to sustain tariffs beyond that 150-day window, it will need either a new legal mechanism or an act of Congress. That uncertainty has a real cost. Businesses can't confidently plan supply chains or pricing around a policy that may or may not exist 5 months from now, and that hesitation trickles down to consumer prices and tenant behavior. Now, when you think about it, the tenants' customers are feeling real price pressure. The pressure doesn't care about the legal mechanism we're talking about. It shows up in traffic counts and average ticket sizes. The Budget Lab also noted something worth watching. Import stockpiles that firms built up before the original tariff wave are now nearly depleted. That means we may see another round of price increases hit retail shelves in the coming months, just as the current inventory cushion runs out. For necessity-based and service tenants, the backbone of most strip centers, the exposure is lower than for discretionary goods retailers. But for any tenant selling physical products at any price points that have room to compress, the next 90 days deserve attention. Now, there's another force we need to talk about separately because it's moving fast and it touches everything else: oil prices and what the conflict in Iran means for the months ahead. Here's a quick background. The US and Israel launched military operations against Iran in late February. Iran retaliated by effectively closing the Strait of Hormuz, that narrow waterway between Iran and Oman that roughly 20% of the world's oil supply passes through every single day. That's about 20 million barrels per day. When that waterway closes, the global energy market feels it immediately, and the effects reach far beyond what you pay at the gas pump. Brent crude oil, the global benchmark, surpassed $100 per barrel for the first time in 4 years in early March and has remained volatile since, climbing as high as the mid $110 before pulling back on diplomatic signals. West Texas Intermediate, the U.S. benchmark, was trading above $112 per barrel as of Thursday. The International Energy Agency has called this the largest supply disruption in the history of the global oil market, greater in volume than the 1973 Arab oil embargo or the 1979 Iranian Revolution. Here's what matters most for the weeks directly ahead. The IEA director said this week, April will be much worse than March. The reason is that in March, cargo ships that had already loaded and transited the strait before the conflict broke out were still arriving at ports around the world. That pipeline of pre-war inventory is now empty. And in April, there is nothing new coming through. So this is not an abstract geopolitical risk. It is an active supply disruption. And the downstream effects on consumer prices, inflation expectations, and interest rates are already being felt in the data we just covered. Now, the US is less directly exposed than, say, Asia. We produce more of our own oil than we import through the Gulf, but energy markets are global. When supply is cut anywhere at this scale, prices rise everywhere. Goldman Sachs has now raised its probability of recession over the next 12 months to 30%. California gasoline prices have already crossed $5 per gallon. For context, for strip center owners, the connection is more direct than you think. Higher energy costs compress household budgets. The same consumer who is already navigating tariff-driven price increases now has less discretionary income because they're spending more to fill their tank, and that's the person walking into your tenant stores. The scenario to watch. Oil industry executives and analysts quoted this week said that the Strait of Hormuz needs to reopen by mid-April or supply constraints will get significantly worse, not better. Now, let's talk about what all this might mean for the transaction environment, because this is where the 2 year waiting story gets interesting. The Federal Reserve H15 released this week showed the 10-year Treasury finishing April 2nd at 4.31%. Earlier in the session, it touched 4.38 before pulling back on news that Iran and Oman may be working toward a Strait of Hormuz monitoring agreement. Fed Chair Powell this week reaffirmed that the Fed is in wait and see mode. Markets are now pricing in no rate cuts for the rest of 2026. Now, taking a look at the US 10-year, for a typical strip center acquisition, lenders are pricing off the 10-year plus a spread, usually 175 to 250 basis points, depending on the asset and the sponsor. At today's 10-year of 4.31, you're looking at an effective loan rate in the 6 to 6.75% range. At those rates, the debt coverage ratio requirements and the cash on cash math still constrain what buyers can underwrite, especially for assets that haven't reset rents to market in the past 18 months. The good news, buyers are out there. There's still plenty of capital to be placed. The recognition is real. Institutions, REITs, and private capital all want strip centers. The constraint is the math, and the math is directly tied to where the 10-year sits. The Iran conflict introduced upside rate risk this week that wasn't there a month ago. If oil prices stay elevated and inflation expectations keep moving higher, there's a real scenario where the 10-year drifts back toward 4.5 to 4.75 before any relief comes. That's not our base case, but it's a risk that wasn't in the conversation 30 days ago. So what does this mean if you're a strip center owner thinking about the next 12 to 18 months? Well, if your property is stabilized and necessity-based, the buyer pool is deeper than it's been since 2022, but pricing is still governed by the rate environment, not by desire alone. If you have vacant space or lease rolling in the next 12 months, that's the work to do right now, because occupancy and lease term directly translate to pricing and lender confidence. If you're considering a refinance and hoping for a better rate environment, the new signals from this week suggest patience has a cost, and that cost may be higher than expected. So here's an honest summary of where we are right now. 2 years ago, we were waiting for rates to come down and buyers to return. That part has happened. The market came back. Capital is moving. Strip centers as an asset class have more institutional recognition right now than they've had in years. But some forces arrived this past week that you need to hold alongside that good news. A consumer under real purchasing power pressure from tariff pass-through, an oil shock from the Iran conflict that is compressing household budgets and threatening to push inflation higher, and a rate environment that may be stuck higher for longer than anyone expected back in January. Now, none of this means that the window is closed. It means the window is open and the conditions inside it are more nuanced than a simple rates are falling, sell now story. The owners who are going to do best in this environment are the ones who understand exactly where their property stands, occupancy, lease terms, tenant mix, rent to market, and who are making decisions based on that specific picture, not on general headlines. If you want to have a conversation about your strip center or your property, feel free to reach out. I'm Ray Kang. Thanks so much for spending part of your weekend with me, and we'll see you next weekend.